Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about HousingWire's 2025 forecast and the outlook for mortgage rates, home sales, home prices, and more as we head into the new year. I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. We are going to talk about 2025, something that I did not plan to do whatsoever in the last decade, but I am glad I'm here. I'm glad we were able to share the last 5 years together doing this. It has been so much fun. It's been a crazy time, and I don't think it doesn't get less crazy in the next 5 to 10 years.
It doesn't. Every year I'm like, oh, well, we've passed peak crazy and then something else happens. So I'm excited about 2025 because obviously your whole demographic work and a lot of the things that you've talked about, your models are from 2020 to 2024. And every time I asked you or somebody else asked you, okay, what happens in 2025? Even this whole year, you're like, oh, you have to wait. So we don't have to wait anymore. This is based on your 2025 forecast. I did want to kind of make a distinction. So you've been doing a forecast for many years, and you always do it at the very end of the year. This year, HousingWire asked you and Mike Simonson, the president of Altos Research, to collaborate on a HousingWire housing market forecast, which we published in the beginning of November, I think. Very popular. People found it very helpful.
First of all, my rule of thumb is we always wait till the end of the year because so much of my work is based off of the 10-year yield and what can happen. We'd like to do ranges and where sales are at. And what's occurred is the last 3 years, something typically happens in November and December. And then, I think people have to revamp theirs. So my forecast is somewhat similar, except Mike and I have a little bit of a different take. We kind of met together in the 2025 forecast. I'm going to give you my kind of raw details of what I'm looking at. And it's a little bit more tilted just for my view. And it gives people parameters for 2025. Like I've always said that a forecast by itself is not logical anymore. A model with a forecast, because we do this every day now, and we, with the tracker and everything, we want to get everybody in tune to what's going on current. So nobody is 3 to 4 or 5 months behind.
I love that. Okay, with that, let's jump in. Okay, so top line, 2025 forecast. Are you bearish or bullish on the housing market?
So what I saw the last 10 weeks in housing for the existing home sales market was actually positive. The last 10 weeks, and we're doing this the day after Christmas, what I saw is that there's a seasonal demand curve that we see in November and December. And the last 2 years is rates were falling down and then purchase application data grew. Purchase application data grew with rates rising. And I've always said that what we've seen in the data in the last 2 years is that if mortgage rates just head towards 6%, you can grow sales. So the HousingWire forecast for existing home sales is about 4.2 million. Because the last few months sales have been picking up, there's actually a chance that existing home sales will be slightly positive for 2024. I believe if rates just head down towards 6%, everyone's sales forecasts will be too low. Because once you get a period after years and years of depressed home sales and you start to see the data firm up with even elevated rates, that just tells you that just the sheer size of the workforce, over 162 million people working, good demographics, a lot of selling equity, credit is flowing, no underwater mortgages in real big matters. There's a lot of demand there ready to go. And every year that goes by after years 2020 to 2024 is that when home sales crash, we're missing millions of home buyers that would have been there normally. They didn't die off or anything. So I'm a little bit more bullish on the existing home sales market than the new home sales market, because the new home sales market is not working from all-time lows. It would have to be around 280,000 new home sales. We're almost up to 700,000 per the last new home sales report. So I could be more bullish on the existing home sales market than the new home sales market. But again, the whole premise has been we've always seen the data get better when mortgage rates head towards 6%. It's just getting below 5.75. I can't forecast that. So I just have to work with the parameters that we've dealt with since rates rose aggressively in 2022.
I think that it really, I'd like to hone in on those last 10 weeks. The purchase application data, as you've said, and I think we talked about in our last podcast, was over the last couple of years, we've seen that sort of demand come in November, December, which is not typical. But we saw in the past 2 years, mortgage rates drop. This year, that happened even though mortgage rates hadn't dropped. Like, that's so crazy to me.
It is. It's just the way I try to explain it is this. When you have anything seasonal, the sheer size of people looking to do something expands. So if you're working from very depressed levels and you're running into a seasonal time frame, there should be an increase just because and it's just weird because in the past decade, this usually happens after the second week of January, but it's happened every year now for the past few years here. So I'm going to just go with that because that's the only way I could explain this. Because if it wasn't the seasonal demand curve, that would be a really big thing that you can grow sales with mortgage rates even rising towards 7%. So for now, I will say it's just a seasonal push. I mean, with 6 positive weeks, 4 negative weeks. The NBA doesn't give the last 2 weeks of the year until the January 2nd, and everyone should kind of ignore like the last 2 weeks of the year anyway because of Christmas and New Year's. But it was encouraging because our pending contracts have been doing better for months now. Like when mortgage rates started to fall down in the summer, it takes 30 to 90 days. You see it in the sales data later. And then pending contracts picked up. It takes months before it hits the existing home sales report. So now we have 2 things put together, right? We have the pending contracts and we have the purchase apps. So a firmer footing, and if rates get to 6%, it's not something you can't disprove. It's something that's what the data has shown us now. And even with elevated home prices, even with rates here, it works. So that 4 million sales level that we always said, that's going to hold the line, right? It's really rare to crash below this. We've been depressed for so long that it's just that the sheer size of the workforce and our demographics are just boosting sales up just a little bit more. And that explains the last few months of the existing home sales market strength.
Let's dive into mortgage rates. This is something that you went into detail on in the HousingWire housing market forecast. That's really the channel is the same, right? Because this is your work about like, here's where you think mortgage rates have to operate within.
So same thing as 2023 and 2024. 7.25% to 5.75%. This is roughly how I used to work in the last decade. But now that we have the last 2 years, what happened? In what we do is we try to teach people like really key levels on the 10-year yield. So in 2023, we brought Gandalf the Grey. For those of you that don't know what I mean, I thought the 10-year yield can't go below 3.37 unless we're going into a recession. I did not see the recessionary data line, so you shall not pass. And we just 8 times we kept on hitting that level and we wouldn't really break it. And then bond yields went up. The problem with 2023 is that the spreads got bad. Spreads were getting better early 2023, but February was looking good. I was like, okay, here we go. This would be more. And then the Silicon Valley banking crisis happened and that ruined everything, right? That's how we got 8% mortgage rates. If the spreads didn't get worse in 2023, we don't have 8% mortgage rate. But now it's 2024. What happened is that the closer you get to the first Fed rate cut, the spread should improve. It improved a little bit earlier than I thought, and it stayed good the entire year. So I just made a video about this. I said, I know a lot of people don't hate that mortgage rates are this elevated, but it could be a lot worse. We could be near 8% mortgage rates instead of around 7%. So the spread's getting better. I've got about 27 to 41 basis points improvement from the middle trend of spreads. You get the 10-year yield now. I've upped the levels from 3.21 to 4.25. I've upped it up to 380 to about 470. That's the range for the 10-year yield, except when we get down to 380, if we do, that means the economy is getting weaker, right? And you need like material weakness in the data to break through 380. And do you remember what we called the 380 level this year, Sarah?
Yes, the Hodor line.
Yes, Hodor. And I don't care if anybody gets mad at me and I mispronounce it. I'm calling it how I want it. Hodor, right? And why did we bring Hodor? Because it took 3 negative jobs reports in jobs week to push us underneath, and then it just shot right back up, kind of like Gandalf. So 380 on the low end with a 10-year, 470 on the higher end. That range, 5.75 to 7.25. That's a workable range with where we are right now. GDP is running almost 3 straight quarters of 3%. That's above trend. Consumption data is firm. Bond yields going up because the economic data is very normal. So we stick with that range. And when we get down to that, if we do get down to 380 again, you're going to need to see more material weakness to break that through. So this is why we do this weekly, daily. We focus on the spreads. This is why we created the tracker, so everybody's versed, because there's still people who like don't know how home sales rose, because there's no modeling work. So that's the range between the 10-year yield, 380 to 470. Same thing as the last 2 years, 5.75 to 7.25. But you can see why the story of 2024, the positive story, was spreads got better, because it could have been a lot worse. And if the spreads didn't improve, we wouldn't even got near 6% mortgage rates. We would have been much more elevated in that. But I think that's a positive story. Hopefully it gets better in 2025, and we're working our way to a level where we can actually grow sales.
What is that left? What's left in the mortgage spreads that you think we could get better just from mortgage spreads?
I mean, you have about 70 to 80 basis points possible improvement, get to somewhere back to normal. I know some people say you can't get back to normal with some pricing mechanisms, but I mean, you get that you're near 6.25 today. That's a game changer. That's what the data has shown us, that just getting towards now, if mortgage rates for some reason, if let's say hypothetical, let's say there's a lot of market drama and the economy gets weaker. If you go below 5.75%, all my housing forecasts, everything goes away. Like pricing will get stronger, sales will grow more. I just haven't been able to get below 5.75 based on what we're seeing in the data line. So if that happens, things could get much better for the existing home sales market, because it's working from such depressed levels of sales.
So you talked about market drama. I mean, this is one of the things we have to consider as we're going into 2025. We have a changeover in administrations, and this administration has talked about how they want to influence the Fed, how they might want to take things out of conservatorship, tariffs. There's all these things out there that are noisy that we have to go, how is that a potential, effect? What potential effect could that have on mortgage rates?
We did that podcast recently about talking about President Trump's policies and mortgage rates and what it could affect. The labor market is getting softer. And what happened during the trade war tap dance 2018-19 is that the general economy in terms of business investment went down to zero. So if everybody's talking about negative revisions to jobs, it was much worse back then. Calculated trade war tap dance back then didn't really create inflation to break out, but it really did cause havoc in the markets, especially to the world economies, a lot of back and forth. President Trump waited until he had his corporate tax cuts first before he went into that battle. So in this case, I don't believe 2025 will be this big trade war or anything like that, but it's something again, when you're dealing with a president like Trump, your headlines are going to be wild. He's also alive and probably will talk a lot too, unlike Biden. So we're going to have to deal with a different kind of atmosphere, to a lot of more headlines coming in, and how the bond market reacts to that. That's going to be the big difference going out, where we had a president that wasn't as vocal and didn't talk as much. So it's something to think about for next year. But again, I'm not concerned about like a trade war breaking out. And because I believe the Trump administration learned from last time, you can't force companies and the markets to do what you want all the time. At this point, it's too much of a risk with the labor market getting softer, not breaking, but getting softer. So for 2025, just, always see how the bond market reacts to kind of any headlines, and we'll address any policy choices when they're officially made and gone into effect and see how it works. But there's a lot of lessons learned in the last trade war tap dance, and didn't create breakaway inflation, but it did impact the economy in terms of lack of business investment.
How long do you think Powell lasts?
Powell will serve his whole term, and then he'll
Hmm.
go away. So I think that's he did his duty, and will go. I think President Trump has come to the realization he can't fire him, and also there becomes a lot of market noise for something like that. So I think we're past that phase of trying to fire Powell. But again, we're going to deal with a president that's going to say a lot of things, and we just have to see how the market reacts to them all the time. So it just becomes a little bit more exciting on that front. For those of you that are part of the Instagram families, we just look at the 10-year yield all day long. So it could get a little bit more exciting on that sense.
Okay, so we have talked about where we think mortgage rates are going to go. We've talked about existing home sales. Let's talk about home prices.
So this is where Mike and I actually differed. Now for 2024, I had one of the lower price forecasts for the year. Adjusting to inflation actually would have been negative 2.33% on an average. I do a range curve as well. So I thought I was going to be 100% right. It was heading my way, and then mortgage rates went towards 6%. And even with the inventory increase, it literally flipped the supply and demand. That's like one of the most beautiful things I'll remember about the last 5 years, is that literally because of the tracker, we were able to see that even in a rising inventory environment, just moving rates down to 6%, getting that 12 to 14 weeks that we thought about you need for positive purchase application data, that really flipped the pricing dynamics right there. And we still have people today that still haven't figured that out or what's going on. So again, my range right now is about 1.33 to 2.1%. So you're looking at a 1.71% nominal price increase for 2025. If you look at the history of housing cycles going back 80 years, whenever you have a big price appreciation period like we've had recently, you're going to have a few years where you have very, very little home price growth. 2023 did not work out because inventory really didn't grow until the second half of the year, and new listings data trended at the lowest levels ever. So pricing was a little bit more firm in 2023. In 2024, because mortgage rates had gone lower, the forward-looking demand got a little bit better, and the pricing was going to get softer in the second half of the year, but then rates went a little bit lower, and we're probably going to end up a little bit higher than my forecast. And always remember, you want to work off of repeat sales. Case-Shiller Index, the FHFA Home Price Index, those things are better than median sales prices, which could get mixed. And never, ever, ever, ever listen to any human being on planet Earth that uses the census median sales price index for new homes and says that's the existing home sales market. If you want to go beneath the devil's den of not being a functioning human being, you use that, and there's a difference. So always use repeat sales. Case-Shiller is really good in that, FHFA, and then it gives you pricing. Zillow does the same thing. So we'll see how that goes. But I'm going to be on a little bit lower side than Mike. I'm using kind of history for my guide here and affordability. But what we've seen is mortgage rates heading towards 6% changes that. So if that occurs, my forecast is at risk. If it goes below 5.75, I'm going to be wrong easily, because they're just going to have more demand, and inventory we're not back toward 2019 levels as a nation. We have pockets where weakness is there. Of course, the South kind of reminds me of the 1990s, where Southern California was the real negative area of the country. You could have home prices rise in a lot of places, and then you could have some southern areas go negative slightly. And then you put it together, you just have a very low level home price growth. But all that changes if rates go down to 6% or even below. So we track this weekly. And again, for those of you that read the tracker, we get a heads up about where things are going. You don't want to be surprised. And it'll be interesting not only for our economic summit in Dallas, February 26th, but especially the first, I would say 8 to 12 weeks of 2025 on what the tracker tells us what's going on.
I think that one of the hardest things to see right now is like that demand. So you have said that there is some pent up demand out there, right? Because we've had 4 years now, 5 years now of people maybe who wanted to get in who got priced out for various reasons. Demographics keeps rolling along. People, form households. They need to change. They need to buy a different kind of house. So how do you look at that demand and decide like, it's because when it comes to home prices, I think that's the key, right? Like how much demand there is, how much inventory there is.
Again, if you look at the history of home prices going back 84 years, it's rare for home prices to fall. And then the only reason we had a housing bubble crash in prices is because we had massive amount of inventory that was distressed sellers. Okay, so if you take 2007 and 11 out of the equation, we only had 1 year where home prices fell. That was 1990. That was 1%. I mean, over 80 years of history on this. This is not like 8 months or anything. So it's just a very rare thing. And we've had historically low levels of demand for years now, and prices are rising, right? This reminds me of the 1980s. This is why I always say that if you wanted to reflect this to a period of time in history, we had affordability was worse in the early 1980s. We had a lot more inventory back then, and we had a recession, and home prices didn't fall. You had the trifecta: rising inventory, crashing demand, a recession, but rates went down. So I think the counter to my 1980s theory is that, well, rates were like 18%, and they had a lot. You could go down 2.5% easily and still be double digits. So can rates get down 2.5%? No. In a calendar year, you would really need to see something terrible happen to the economy to get mortgage rates from 6 to 4, under 4%. But mortgage rates just getting down towards 6, getting sub 6%, it's enough to change the supply and demand equilibrium. And we saw that in 2024. So sales are low, but prices were rising when sales were low. But I always look at it this way. The existing home sales market has had the fastest sales crash ever in 2022. And then it's just basically stuck. The new home sales market never had that. New home sales market are still very elevated. We have near 5 million total home sales. Like 5.4 to 5.9 was like normal in the past decade. So we're missing about 500,000 to 1 million mortgage buyers. What brings mortgage buyers in? Rates go lower, right? Especially with more household incomes put into the equation. So that's how I'm looking at the home sales and price equilibrium. We have over 4 months of supply currently. Oh, actually, for a few months, we did have a 4-month supply. It went down in the last existing home sales report. So we're in a much healthier spot right now with the inventory story that we can handle mortgage rates getting down towards 6% without 15 to 20% home price gains. We'd have to worry about that. If inventory was still at the 2021 and 2022 levels, no, I'm still in the savagely unhealthy housing market discussion, but we're not there anymore. The benefits of, unfortunately, depressed mortgage demand is that inventory could grow. The theory of mortgage rates preventing inventory from growing, the mortgage rate lockdown theory, that didn't work out. It's been rising since 2022. So positive for housing, more choices, more sellers have choices, more sellers can be buyers, but the price growth had to cool down, and that's what it did. That's a very, very big positive for the future of housing in America.
Builders have had some pretty good years because they've been able to buy down rates. What does their year look like in 2025?
This is where it gets very interesting, because when I think of the builders, I always think about, you have to think about the builders as what, Sarah?
They're in it for the money. They're not the March of Dimes.
They are not the March of Dimes. So profit margins and supply matters to them, where an existing home sales market is basically buyers and sellers have to move for various amounts of reasons. The builders aren't like that. Builders are, they sell homes as a commodity. So when you sell homes as a commodity, you have no emotional mix or anything like that. You're just there to make much money as possible and move on. Supply is increasing for them on the completed unit sale. It's not a lot. It's 120,000 there's over 146 million total units in America, so it's a very small amount of numbers. But for them, they're just a little bit more mindful. And one of the more craziest and maybe frustrating things for the American bears is that they don't understand why residential workers are still working, And again, it is a very complex, unique cycle. You had the backlogs, you had the rate pie downs, you had the long turn time. We had all these things that just weren't happening. But the gross profit margins of the builders it was really good during this period of time. Back in 2007, it was like 15, 16%. And then it just had a waterfall dive, negative 20% margins on the new home sales market. You don't have that here. We still have elevated profit margins, but it gets harder and harder to do stuff now as inventory increases, especially in the South. This is why permits and starts are at recession lows. So as we're moving through the backlog, 2025 becomes a legit year where you can lose some residential construction workers, more on the apartment side, I would say, than the single family side. But even single family is at risk. And we saw this starting to take hold when mortgage rates got to 7.5%. We had one negative residential construction, and then rates went down to 6%. And then the builders felt better, permits were right, and then rates went back up again. And now, so it's one of these tug of wars that are viciously slow in terms of this, like a clear direction. And even today, the new homes purchase application data is still positive year over year, right? The monthly sales have been back and forth, really stagnant, but we're not below the 2022 low. So builders, to me, it's a profit margin supply story. And it shouldn't shock anyone that housing permits and starts are at recession levels. If rates go down towards 6%, we're going to build homes again, and new home sales can grow. But elevated levels just make it more difficult, especially from the South. Again, so much of the new home sales over the last few years have been in the South, and now that supply is increasing. Some more affordability issues there. Corporate profit margins, that's the key kind of mindset for me for 2025. Margins and supply for the builders.
That sounds good. Okay, what do you see for the general economy?
So the general economy, again, consumption and growth has been above trend. Everybody's been wrong about the economy. So nobody wants to fully admit it. Even myself, even me fighting the recession people all the time. The economy is still expanding at a rate where the Federal Reserve feels that it's comfortable not pivoting like full weight. They did a baby pivot, which is really critical. But I'm gonna actually go back, and President Daly from the San Francisco Fed just talked about this. They asked her about housing. And she's like, well, when we cut rates, we noticed that some of the builders got off the fences. I'm like, really? Did that happen? Housing starts at recession level. So when we think about the general economy, just remember, economic cycles all kind of somewhat look alike. There's either some kind of shock or something that pushes consumption to a negative level. Because so many homeowners have done well financially, balance sheets are so good, we've been able to handle rates shooting up as much as it wouldn't have happened in previous decades. But you want to keep an eye on the residential labor. Every time we go into a recession, this data line falls every time. So we're just waiting to see, does the corporate profit margin pressures and permits keep on going lower and lower, does that finally end this? And then we start to lose. And if you start to lose jobs, the unemployment rate can rise. We don't have a lot of wiggle room anymore. The labor market's getting softer, but not breaking. That can actually, in time, lead to lower rates, which is actually will benefit the existing home sales market more before the new home sales market. So that's kind of where I'm thinking right now. And then we have other variables where the market stress, if the dollar gets too strong again. By the way, if the dollar hits 115, I'm going to be the dollar for Halloween again in 2025, because the dollar getting too strong is going to create world chaos again, and that's probably not a good thing. So those are the things that I'm really tracking for the cycle right now. Is since they've cut rates, we can no longer have a soft landing discussion anymore. That's over with. They were able to keep the economy going and cut rates, and we never had a job loss recession. You can't sit here and think soft landing every single year until the world's ends. So we're moving more into an economic cycle discussion. So corporate profits, especially for the builders, see how that's working. How's housing starts and permits? That's where the focus is. Does the market have another drama effect with the dollar getting stronger in Trump stocks? We'll take that into consideration as the year goes on. But that's my focus for the economy right now. It's housing, because traditionally housing leads you in the recession. Traditionally housing leads you out.
Well, I'm glad that you're going to be updating us weekly, because I feel like we're heading into a year that, good or bad, we don't know yet, is going to have a lot of things happening. So we will see, as always, but maybe even especially after we have the inauguration. So I would encourage everyone, follow the housing market tracker. Logan writes it every weekend. We publish it on Saturday, sometimes on Sunday if we have something crazy happen. But that tracks all these different data lines, and then sign
Sarah's
up.
getting her hair done on Saturday.
Yes, because you'll be like, okay, it's done, and I'm supposed to edit. I'm like, okay, I'm literally doing something. So,
That's why I just said it. Unless Sarah's getting her hair done and it comes out on Saturday.
but that's not why we do it on Sunday. We started doing it. We used to do it, and then we had those bank. We had the bank stuff happen over the weekend. So, instead of doing it Friday, we're like, we've got to do it like Sunday. And then we haven't had anything that crazy for a while, so we moved it back to Saturday.
I think it's better to for the weekend just in general, so it gives you an outlook. But again, if anything significantly changes, we'll see it first,
Yep.
and we'll let you guys know. And just for context, again, one of the reasons why we like our new listings data is that hopefully by now, everybody knows the housing price crash people are crazy, right? They're just professional grifters. But what we saw back then is that new listings data started to take off. And these were not sellers that were going to be buyers either. And distressed markets were taking off. So if something happens in the data line, we'll be months ahead of the NAR's existing home sales report or anything. That's why we're very key on weekly data, because it looks forward. Right now, pretty stable. 2024 was like the second lowest new listings data year ever. I thought we'd get to 80,000, and that we got to around 75,000. So I was off about 5K. I just want to implore to everybody, this thing was running at 250 to 400,000 per week
That
for
is so
years.
crazy.
We are ranging between 30 to 90K for 5 years now, right? Back then, I mean, even in the seasonal decline periods where, you're running at 30 or 40,000 a week as the year ends, this thing was over 250,000 even back then. So when there is market stress, we'll see it first. And this is why I always say that if you see stress, new listings data will go vertical. Never happened. All that smoke and jazz about Airbnb and people were broke and credit, all that, nothing. It was literally the two lowest new listings data year ever in the history of America in 2023 and 2024. So let the people that track this for a living, who actually do it professionally, we'll guide you there. We'll hold your hands 24/7. But again, what I'm doing right now is a forecast, but the forecast is irrelevant without a model. This is why I'm not the older I get, the more I just think forecasts are useless unless you have a model to go with it, because things change during the year and you want to be there live and fresh, because when you have a material change or a variable, it could change the cycle. And that's what 2024 did. The mortgage rates were just heading down to 6%. So we'll be there. We won't let your hands go. We are here 24/7. I literally have nothing else to do in my life but this. So let's have fun in 2025.
Yeah, you don't have to take time to get your hair done, and yet your hair looks great. And look at what is going on here. I will say, in addition to the tracker, which is based on Altos research. I mean, this is the thing. Altos research data is the why you're like a kid in a candy store every weekend, because you get all that fresh data. And this is what
Yeah, I mean, with Altos, it's funny. The one thing I needed for my model to complete it was weekly data, and like there is a lot of stuff that we see that we don't share to the public, only to our private clientele, like Wall Street and professional real estate investors and high-end real estate agents. So there's things that we see, but to like incorporate it with my 10-year yield economic cycle work, it was just like the magic
is
key
perfect.
finally, fit into the lock, So I was, again, once I knew that Altos was coming on board, I was just like, oh, I'm in heaven.
I
No,
know.
you're all of you doomers are in trouble right now, because I'm going to specifically, like surgically, like show how wrong you guys are by showing how a proper model works. Because that's how nerds
Absolutely.
roll. They roll with models.
Speaking of nerds, we are gathering the best economists in the country for housing, for our Housing Economics Summit, February 26th. Come here, Logan. Come here, Mike. Come here, Jessica. Come here, Barry. Come here. We have so many. It's amazing. It's going to be great. And then they can also meet you. We're going to have a Q&A session as well.
Yes, and I think that's a very useful event because everything's going to happen in one day, and you have so many different takes. There'll be a lot of data to digest, and also the Nerd Tour is getting bigger and bigger, right? And I think we already have 26 cities already, for 2025. So I cannot wait to see everyone in Utah, Columbus, Ohio, Bloomington, Illinois, Texas, Florida. There's so many places that, and I think we're going to be in Colorado, Denver, maybe 3 or 4 times in 2025. So I can't wait to see everybody in the Nerd Tour. And always remember, ask questions. The best part about the Nerd Tour this year is their Q&As were just simply awesome. They were a lot of fun to do.
Love it. Okay, Logan, we will talk again. We are, as you said, we're having this discussion on December 26th, but it's going to go out at the end of the year. So thank you so much for a great
Happy New Year, everyone. Happy New Year and down with the American Bears.